Donald Trump and the markets, what the local economy is doing, looking a lot better than people expected, and how am I going to invest this year? I'm Peter Switzer and I'm mad about money, but I'm also mad about Marty and Paul, who are on holidays. And as a consequence, I'm doing mad about money by myself when I actually should be going to the tennis, but I'm here doing this because I care about you. Anyway, so let's start with Donald on Saturday, the inauguration speech. Big question is, will bad Donald or good Donald show up? Good Donald talks about tax cuts, less financial regulation, and infrastructure spending. The markets love that. That's why the stock market's been going up. But if bad Donald shows up, the guy who talks about tariffs, fighting the Chinese on trade and picking on the poor old Mexicans, and even today he talked about a 35% tariff on German cars. Germans didn't like that. They actually said, well, if you're whinging about us having better cars than you, why don't you just start making better cars in America? Good comeback, I thought. Anyway, so what he says on Saturday, our time, could really affect markets next week. We've got Xi Jinping, the president of China. He's talking at the Davos World Economic Forum. He could come up with some pretty negative things. He's pretty cheesed off about Donald Trump for a whole variety of reasons, and that could hurt stock markets next week. And also, Theresa May, the British PM, she's talking about Brexit, and whatever she says about Brexit could easily affect markets for the rest of the week. So a whole lot of stuff coming from senior leaders around the world could affect the stock market. Now, what about the local economy? Just before the holidays and whatever, we saw that the September quarter was a negative, and so some doomsday merchants said, well, there could be another one in December. Look out for a technical recession. I disagree. I think they're totally wrong, and the latest round of data kind of convinces me that I'm actually right. So let's have a quick run through. I have to sort of just go and read this out, make sure I've got it all. What's really interesting is consumer confidence. Roy Morgan's look at consumer confidence. That is now at something like a 4-month high. We had job vacancies there at a 5-year high. These are all data coming from the December quarter. New dwelling approvals up 7%. They tell us the housing sector was losing a lot of momentum. A 7% rise in housing dwellings. A trade balance, first surplus, a trade surplus in 33 months. Trade surplus means demand's coming in from exports and whatever. That's good for the economy. We've also seen both manufacturing and the services sector. They've got numbers well over 50. Any number over 50 means that these sectors are actually expanding. Something like 22,000 jobs were created in manufacturing this year, which is really a good thing, because a lot of people said manufacturing was completely dead and buried in the water. So I'm really happy about that. Also, there's a really interesting index. It's the actual movement of planes between Sydney and Melbourne. One of the busiest airline sector in the world, and it's increasing. It's growing at a faster rate. Craig James at Comsec says that's a really good business indicator. I certainly like that. Also, the credit card balance, average credit card balance went up by about $73 in November. There's another sign that Aussies are starting to spend. So all up, really happy about the Aussie economy. Finally, how am I going to invest this year? Well, last year, Paul and myself and Marty, we talked about big cap stocks were beaten up. We thought they were the good investment for last year. They're really rocketed home. Banks have done well. Miners have done really well. I think some good small and mid cap companies have been dumped, while fund managers have chased the big cappers. So Paul and I will be particularly looking around for those small and mid-cap companies that have been picked on and also have a history of paying dividends. We like dividend payers, and those that grow the dividends fast, they're the ones we're going to be looking for. I also like a little ETF stock called IOZ, and that's the iShares ETF for the Australian stock market, ASX 200. Now, we're at 5,700 run at level. I think we go to 6,000 this year, and then maybe 6,300. If we get to 6,300, that'd be a 10.5% increase just playing the market. That seems a pretty easy way of making 10.5%. Plus, you then get 4.5% in dividends plus franking credits. So that looks like a really good way of playing the stock market. But Paul and I are also going to be looking for other stocks, which we'll share with you with Mad About Money over the course of the year. And also, I've got a really important investment I'm going to share with you over the next couple of weeks, which is something I really have a lot of involvement in, and I really think is going to be a beauty for this year and going beyond. So stick with us on Mad About Money. I'm Peter Switzer. I'm Mad About Money. See you next week.